Good morning or good afternoon, and welcome to our webinar, Capital and Liquidity Planning in Response to Rising Interest Rates and Related Adversity. My name is Jeff Rigsby. I'm Chairman and CEO of CV Resource and Finance 500, and I will be your presenter today. Just for those of you who may not be familiar with CV Resource or Finance 500, we are based in Irvine. We do operate under common ownership, and together we serve over 2,000 banks across the country. CV Resource is an industry leader in enterprise risk management, strategic and capital planning. We do specialize in ensuring our community bank clients actually exceed their performance expectations and synchronize their performance and risk management priorities. As far as Finance 500 goes, we are a leader and we are a full service broker dealer, and particularly a leader in CD underwriting. Over the last decade, we've exceeded over $200 billion in funding, and we continue to support the alternative funding needs of our clients across the country. Together, we're united to serve the best interest of our clients in pursuit of optimal financial performance. So let's go ahead. And before we jump into the context, just to get the most out of the webinar, we do have instant messaging capability. Feel free to ask questions during the course of it. The presentation is being recorded and the material will be available after we wrap up. So to the extent you would like a copy of the webinar itself, it will be available. So what are we going to cover? I'd like to spend a little time talking about the market forces that drive our decisions as it relates to capital and liquidity. I want to talk a little bit about the key risk considerations related to those market forces, and then we'll dive into the discussion specifically around capital and liquidity planning and what those critical components are, what they look like, and in the end, we'll wrap it up and pull it all together. So let's just talk a little about kind of what got us here. And I think what's interesting to point out, whether we're looking at capital or liquidity, as an industry, we like to run in a certain band. We like a little tension in our business operations. We've got loan growth, we've got deposit growth, and they tend to run along a common track. And, lo and behold, when the pandemic hit right around the end of 2019, early 20, all of a sudden we had this surge, brought on by stimulus, brought on by PPP and other related activities, people not getting out. And all of a sudden, as an industry, we had this surge in deposits, right? And we all experienced that. Specifically, the industry grew about 4.5 trillion in deposits over a relatively short period of time, about 6 to 7 quarters. At the same time, if you net out PPP loan activity, loan growth was modest or almost flat. So in essence, what we ended up getting is this big pop in surge in capital, and if you're in deposits. And if you think about it, if we were all in the trucking business and we were selling F-150 trucks and we're selling 1 or 2 trucks a month, and then all of a sudden Ford comes in and says, hey, by the way, here's 100 trucks you need to move. And that's what receiving $4.5 trillion in our business kind of did to us. And so when we think about our business as somewhat of a formula, as I mentioned, we like a little bit of constructive tension, if you will. Loan growth typically in the best of times is somewhat below or somewhat above deposit growth. And that's where we like it. We look at our loan to deposit ratio, we track our business. And if you think about it, pre-Great Recession, this dark blue line is loan growth, the lighter blue line is deposit growth, and that's a band we like to run in. Great Recession hits and boom, loan growth falls through the floor. Deposit growth continues to kind of hold its line. And all of a sudden we have this little bit of surge in securities to offset the lack of earning assets on the loan side. And then all of a sudden we roll into this, pristine period from say 2011 on, where it was just a time of prosperity, right? We got back to that desired tension of loan and deposit growth. And then all of a sudden COVID hits. We see our loan deposits, with the exception of PPP activity, loans kind of drop and deposits kind of shoot through the roof. And what's interesting about that is it threw us into a discomfort or a disruptive environment that was new to us and new to the industry. And with that happening, it kind of forced us to look at alternatives to fully take advantage of this additional funding we received. Now, I do want to point out just at this juncture, though, in third quarter this year, if you can see our deposit growth spiking through the pandemic, all of a sudden, for the first time in third quarter 2022, loan growth is now exceeding deposit growth. So it does appear we're moving back into a constructive tension that we tend to like on an operating basis. But with that, so what did happen? So we got this $4.5 trillion in deposits, and lo and behold, we've always liked running in this nice, tight, narrow band of operating. This is 20 years, and bang, again, COVID hits. And what was the result, and what did we do with this 4.5 trillion of excess liquidity that the feds were so good in allowing to stream into the market? Well, we invested, correct? I mean, we didn't want to stick it in overnight funds. Hopefully many of you stayed shorter, but we did end up investing those funds. And so what you're really seeing here is that pop in securities growth. And with that, extraordinary growth in securities, it's fair to say that hundreds of banks, if not thousands of banks, followed this pattern. But it also put us in somewhat new territory. For most banks, they kind of like most of their earning assets to be in loans, and then they augment it with a security strategy to optimize the balance sheet. Well, in this case, it kind of took it up to a new level. And in many cases, securities portfolios grew as much as 300% or 400%. And with that happening, what happens to the balance sheet? Well, all of a sudden, we have record bond levels. Held to maturity is actually, as we look at it today, is up 2.5 times above any level that we've seen in the past. So we've got this nice spot. And if you think about having held to maturity, doing that, I mean, just think about it. So some of you and many of you may have done that in order to avoid the mark-to-market activity on available for sale. But nonetheless, it now has created a condition within our balance sheet that we have to manage, right? And for those that are longer in the curve, that certainly led to a certain consequence in terms of mark-to-market or GAAP capital accounting. But nonetheless, it's with the rising interest rates surging, it kind of a time after we make this large investment in bonds and securities, all of a sudden we're now reaching the point of a rising interest rate environment. And when that occurred, we've got reintroduced to the whole potential impact of tangible common equity. Now, bear in mind, we don't talk about tangible common equity all that much, with the exception of a trading environment. And this is the narrow band, again, that we typically run over the last 20 years. And this is where TCE is today. So what we've experienced is tangible common equity took a hit. We have about 35 banks in the country now that have actually gone negative on tangible common equity. We have over 500 banks that are below 5% in tangible common equity. FHLB has kind of come out and suggested that if you fall at 0 or below, they may restrict or even deny you the credit facility to pledge those securities to support funding and liquidity. So nonetheless, what we found is this condition has continued to change our standard operating conditions, if you want to look at it that way. So taking that into consideration, what does that mean? Well, perhaps it stalled some of our M&A strategy. Perhaps it put off some, either an IPO or raising new equity capital or even sub-debt, because we have the rising interest rates and we now have this balance sheet consideration. And certainly having that balance sheet condition also does somewhat limit things we might do in terms of managing our balance sheet. So the impact to liquidity, again, we are creatures of habit. We like to operate within bands. And this dark blue line I'll stick with, which is basically banks between 1 and 5 billion in assets. But 15 to 20% liquidity was just a nice comfort zone. And if you look at over time, we kind of ran up a little bit during the Great Recession. It kind of spikes, and then it comes back down during this great time of prosperity from 2011, say, to 2019 or early 2020. And then all of a sudden, boom, again, we see that our liquidity spiked, and that's what drove us to pursuing alternative investments. And now, though, we're all of a sudden seeing it tick back down. And we're starting to see what the feds give in terms of excess liquidity. The feds have decided to perhaps suck a little bit of that liquidity back out. Many of us are dealing with that. We're seeing treasuries 1-year treasury is now our greatest competition out there at 4.6, 4.7%. But what that's is obviously done is it's put a strain on our liquidity, not to mention just what the economy is doing as it relates to our customers' behavior with their deposits. So when we take a look at that, liquidity is now kind of starting to show a downward trend. So we're seeing liquidity tightening. But then if we look at the alternative funding market, that's changed as well. So if you take a look at looking at, for example, brokered CDs issued in the market, we go back to Q1 of 2021 through Q4 of 2021, you saw this kind of, standard, relatively stable line of funding. And all of a sudden, at that same time, when interest rates spiked, our bank liquidity started going in this direction. And then all of a sudden, we see this alternative funding, both in terms of average yield increase over time. You can kind of see that spiking out here. So we're now seeing coupon rates, average coupon rates at about 4.3, highs at about 5.3, and you can certainly see where we are at various levels. So it's fair to say that rules of engagement and the overall environment has materially changed. And that's what we're kind of finding that we're all faced with. And so if we take rising interest rates, excess liquidity, and now certain economic conditions, so the Fed has determined they're going to pull some of that liquidity back out. They want to put a curb on inflation. And so now the question is, with these rising interest rates, with this monetary policy, do we all believe what's being said, that the economy is basically going to weaken? And so with that condition, does it weaken to the point that we roll into a recession? Do we roll into stagflation? One way or the other. I kind of use Moody's. This happens to be Wells Fargo's global economic folks. But the bottom line is the forecast is we're in for a weakening economy. And when we think about those conditions, both in terms of liquidity and capital, a couple of things happen, right? Are we concerned about credit quality weakening? Are we concerned about our clients needing more funds to fund their lifestyle and their living in a rising interest rate environment with inflation and other factors? So most of us are kind of believing that we are going to see a weakening economy, most likely as we roll into Q2, 3, and 4 in 2023. And if Wells is on point here, we start coming back out in 2024. We see the same thing in Fed funds, rising up and then kind of curving back down in 2024. But nonetheless, this is, again, disruptive to our model. It's disruptive to our operating conditions, which also brings us back to the question, what's its impact to capital and liquidity, and to continue to look at things like unemployment. So the general assumption is we're likely to be in for a recession. We're likely to continue to see the Fed's monetary policy driving interest rates up, albeit maybe more gradually, but certainly an intent to pull or suck that excess liquidity back out of the market, which again is kind of forcing our response or bringing us to a response. So what is it we're dealing with? These rising interest rates will probably continue to drive negative AOCI. And if your average duration is out there on the longer end, because perhaps you're a subchapter S bank and you went more towards the munis, or you ended up through your planning that you're a little longer, that just kind of exacerbates it, right? But nonetheless, we've got this negative AOCI thing. We've got this mark-to-market condition, thereby, at least on a GAAP basis, messing with the balance sheet. But that does have some consequences, right? And with that lower tangible common equity, it does have an influence on some of our strategic decisions. And it may have some influence on how you're working with your regulators. But it certainly changes the M&A market. It certainly changes the ability to go out and raise capital. And it may even restrict certain balance sheet activity. You certainly can't shrink your balance sheet if you're running elevated mark-to-market levels. It would just be improved, correct? I think the other consequence is the Feds aren't going to reverse their reverse action of pulling and sucking that excess liquidity out, right? And what the Feds give us, they take away. That $4.5 trillion came in. We're now seeing the competition in the market pulling that liquidity to somewhat. Many of you are experiencing that liquidity pull. And bear in mind too, if the economy is weakening, that also means those excess funds that have been on deposit with us may likely be needed by many of our customers to either continue to fund their life, their living, their businesses. So we have this tension, both in terms of capital and liquidity. And depending where you are on that average duration, could only exacerbate the condition. And then, it is a side note, if you're holding on to mortgage-backed securities that were acquired over the last, say, the previous year, for those of us that are kind of counting on prepays to accelerate some of the movement in our bond portfolio, it's not likely to happen anytime soon. So these are consequences. So what do we do, right? So what are our options? And one proactive response, and many of you, I'm assuming, are doing this, and I really want to spend the balance of our time just talking about, so what do we do? We have stakeholders, we have our business strategy. Most of us are in strategic planning mode right now. But what is one way to proactively respond? And I'm going to take the balance of time to talk a little bit about what that looks like, at least from our perspective. And first and foremost, the proactive response is not just to model things, but to actually, and for those of you that have an active capital plan, grab it, integrate liquidity, but basically you want a fully built out document and documentation that first of all articulates your specific condition. So when we look at all these conditions, we all somewhat are unique in our strategies, somewhat unique in our asset size, somewhat unique in the level of complexity. We all have our own business models as it relates to banking. But nonetheless, when you think of a proactive response to somewhat of a capital aberration is what we're experiencing, a liquidity readjust is what we're experiencing, we want to basically document our condition. And once we document that condition, what is the impact to that condition? And then specifically, what is our response? And so as you look at doing that, I suggest as you do that, if you're not already doing it, is that you leverage regulatory guidance and frameworks to do that. And the reason I bring that up now is if you're going to do it anyway, that means you're likely to have to communicate it. Part of your audience are going to be regulators. So let's be efficient about it and use some of their frameworks, models, and guidance to make the process more effective. Because in the end, the communication process is key, right? So you want to document it, you want to leverage regulatory guidance, and ultimately you want to effectively create a vehicle that communicates well to your key stakeholders, whether it's your board, whether it's your regulators, investors, or even your workforce. So now I'd like to just step us through and take a peek at what those things should be. And I'm going to do a couple of things. I'm going to use our framework because it's easier, but I will tell you, you will leave with a presentation. If you want to build a capital plan, you don't have something like this, the balance of this presentation will give you the guidance to do it. But here's the three things I want you to think about that are the non-negotiable aspects of what need to go in your plan. A capital and liquidity plan is not just an Excel spreadsheet modeling a bunch of scenarios. It's a documented approach that says, I understand the environment. These are the conditions of the environment. These are my response. So I suggest to you, it should consist of three things. Number one, your capital and liquidity plan should be directly aligned with your strategic plan. It should include a comprehensive risk assessment that associates what your risk profile looks like under these conditions. And it should have a contingency plan that would reflect what you would do under various scenarios, such as articulating triggering events, as well as the responses to those events. So I'm just going to take a few minutes now and walk you through what a plan like this looks like, bearing in mind that the balance of this presentation will give you a how-to. If you don't have a construct for a plan like this, it'll walk you through. I'm going to actually take the balance of this time, and hopefully you can see this if I have it up on a screen. But this is a standard structure of a plan, right? It's going to have an executive summary, and it's going to basically speak to what are the rules of engagement, what's your capital intent over a planning horizon, which should be linked to your strategy, and what is your risk profile, and what does your contingency action plan look like? So if you think about it, this is your working table of contents. And I do want to reinforce this isn't just slapping down and throwing assumptions into a model and expecting some sort of black box to tell you what's going to happen. That needs to be integrated in the plan, but the plan is a plan, and it should consider these three factors. So let's just take a quick look at what those factors would look like in your plan. So number one, just leading right off the bat, it's rules of engagement, right? It's what are the operating conditions I operate? If I'm an FRB, if I'm a Fed member bank, I've got certain rules of engagement. If I'm OCC, I've got certain rules of engagement. If I am a state chartered non-Fed member bank, I've got certain rules of engagement. If I'm a industrial charter bank or an industrial loan bank, I've got certain rules of engagement. But you want to articulate those, and you immediately want to lead with your key assumptions and priorities related to your strategic plan, right? Because everything about capital and liquidity planning should be directly aligned and rooted in your strategic intent and your documented plan. So in so doing, lead with that on the front end, and also speak to what the rules of engagement are. Just bear in mind, remember, you could be fully capitalized under PCA standards, but if you're not compliant at the Basel III plus minimum standards, you could still fall out of compliance, and that's still a consideration you have to have from a capital standpoint. But when you look at it, this is just the executive summary section. Articulate your risk profile and select those key risk characteristics, right? Credit risk, interest rate risk, liquidity risk, ops risk, capital risk, strategic risk, but build out the risk profile, build that right into the plan. So anybody, just whoever you're communicating with, board, regulators, whatever, understand that you understand what your overall risk profile looks like as it relates to capital. I will tell you that we use a model that looks like this, and many of you might have it, but once you know what your risk profile is, take that into looking in your capital levels. If PCA well capitalized is 5%, your implied minimum based on your risk profile might be something above that. Then your policy level is X and your actual level is Y. But be able to speak to the impact to capital on your actual risk profile of the bank. Once you go from there, the capital goals section. So now I'd just like you to walk through it. I think you've got a feel for how the plan rolls. By the way, for those of you at the bank holding company level, in addition to everything else that your capital plan should include, it should also speak something to your double leverage ratio. And that is a consequence as it relates to bank equity versus bank holding company equity. And then obviously you want to have your pro forma estimates, and whether it's just at the bank level, which you can do, or including both bank and holding company, and your key financial ratios. And then the last component is your contingency plan, which literally says, what are the conditions that would trigger a reaction? And I'll show you what that looks like in just a moment. So now I just want to give you kind of a general perspective on what each section of the plan should look like. So when you talk about risk profile, you want to describe specifically what the risk is. So if we're looking at credit risk, here's the regulatory definition of credit risk. Here's our overall risk profile. Here's a summary of my findings regarding my controls. Here's the unfavorable factors or emerging risk and threats, some hard data associated with trends, my 3-year forecast on growth, my concentration levels, my stress testing if I do that, and then the overall key risk conditions on a comparative basis from a key risk indicator standpoint. Now, just think about that as a framework, right? Interest rate risk, define it. What is my risk profile? What are my favorable controls looking like? What are my unfavorables or emerging risk and threats look like? Integrate your ALM and ALCO data so you can look at interest rate shock and EVE shock and build that in. And again, follow the same rhythm though, right? Risk profile, controls, emerging risk and threats, key risk indicators. And there should be this. Now, liquidity, you want to punch it up right now, right? Because if any of you have talked to regulators lately, if there's a hot button rolling into next year, liquidity is certainly it. So your liquidity section should definitely have a strong definition of what liquidity risk is, what your risk profile is, what your forecast for liquidity looks like, both in terms of deposits and liquidity ratios, your stress testing. And one thing that we would certainly encourage is you beef up or expand your contingency plan. So whatever you have in your CFP, build that into the plan. Let them see it. Let them understand that you've got your heads around the alternative funding necessary to respond to any condition from a liquidity standpoint. And again, I'm just going to kind of move through these, but the reason I'm showing you the plan versus just showing you kind of screen captures is it's a working document. It's connected, it's fully integrated, and it tells the story of your bank. So we've looked at your risk profile. I do want to spend a little quick snapshot on capital risk. When you get there, there's one thing to, shock, look at interest rate risk and look at credit risk and do simulations and shock it. When you're doing a capital plan, you want to look at those same scenarios, but you want to look at them over time. So you've got a base case, you have perhaps an adverse case and a severely adverse case. But what you want to be able to articulate is the movement of levels of capital associated with those risk conditions over time. So if something does happen, it's not just a shock, it's what's the recovery period and how do you move across those key risks or those key capital ratios under each one of those scenarios over the planning horizon of the plan. So if you can just see what this looks like, you've got a red line going across each of the 4 key risk capital ratios or key capital ratios. Are you above or below where you need to be? And that's over time. That's not a shock. That's over time. And I think that's critical. And then lastly, strategic risk. You want to make sure you talk about where you're going, some key risk indicators, and other factors that you've woven into your discussion to articulate you understand your strategic risk. Capital and liquidity plans are pretty straightforward. This is just a snapshot of the minimal things that should be in there, which is here's where we are today, here's where we are over the next 3 years. These are my specific intentions. And oh, by the way, here it is modeled out, and here's the key ratios that you should be tracking. And pretty straightforward. It could get more elaborate based on your business model. And then lastly, I want to talk about contingency planning, and this is key in any capital liquidity plan. And some of you may or may not be as comfortable as you know articulating specific triggers, but it is I would say in today's world pretty critical. So here's just one sample of how to get there. So whether you're looking at credit risk, interest rate risk, liquidity, ops, capital, strategic risk, what are those key risk indicators? What are your risk tolerance levels going across the bands? Risk weight them, and how are you operating within those tolerance levels? If you start moving against tolerance levels to elevate your overall risk profile, then your triggers should map that. And you should be able to link that to a response. And by the way, no one triggering event, creates a reaction, but you should be able to say in a standard operating environment, this is where I'm at, and this is how it ties back to my score. If my risk elevates to moderate, high, here's some of my key actions that will be put into place in order to mitigate risk associated with that. And obviously, if I fall into a higher range, it even gets more specific. So what I really do is just want to show you is that think about those 3 elements, right? Risk profile, capital plan and liquidity plan, contingency plan. And that kind of gets you to the end there. And I hope you don't mind that I walked you through a plan document instead of presentation. I am going to show you what I have in the presentation for your own benefit. If you like the structure and want to build it back in, I do have deeper or screen captures for each section. So you'll be able to take a look at how to build the risk assessment, how to look at each one of those key areas, how to look at capital liquidity adequacy aligned with stress, how to build that contingency plan, right? Those are the key elements. So I know this has been a relatively fast flyover, but I did want to take this opportunity. We're all in planning session right now. We are all to some extent constrained in our resources. So having a model to follow, having a discipline to follow is worthwhile. So just bear in mind, these are the elements that you want to build your content around as you look at responding to these pretty significant turn of events that we're dealing with today. And so that plan should have that executive summary, integrate your risk profile and assessment, articulate your capital and liquidity goals for a planning horizon tied back to your strategy, articulate a well thought out contingency plan, including key risk triggers, and then your supporting documents in the appendix. With that, I think you will have a response that will be suitable for you as a management team to say, hey, we've considered capital and liquidity given what's going on with rising interest rates, given what's going on with recessionary activity, given what's going on with the regulators overtly and aggressively trying to take back the liquidity that they created in the first place. So this plan is your tool, along with your strategic plan, to articulate to any stakeholder how you manage it. So I hope you find these screen captures handy. I hope you found the outline handy. I will defer to any questions any of you might have. But I do want to let you know as well, you're busy. Many of you are our clients. I know many of you aren't. but I do want to just share with you, and I'll go back to Q&A. If you like what you see and you would like additional support or guidance, I think you can look at the crib notes in this document, this presentation, and probably take care of business. If you would like professional support, let me just tell you, this is what we do. For over a decade, we are doing hundreds of these plans for our clients. We do most of the heavy lifting. Each plan is totally customized to align with your strategy, with your business model. We don't stop working with you until you're satisfied. Finance 500 and CB Resource are relationship-driven companies. If you are one of our clients now and you don't have a capital plan, you will receive favorable bundled solutions because of our relationship. And you do get a capital, with your capital plan, you get a 1-year subscription to CB Bank Analytics, which is our diagnostic and interactive platform. So, there's no free lunch. I hope you found the content interesting. But I do want to let you know that if you want a turnkey solution, reach out to Robert Finch. His information is tied to this presentation, and he'll get your proposal and any other related information you might have. But at this point, I will go back and see if there's any questions regarding the process or anything that you might want to expand on or learn more about, in whether it's how you model the plan itself, how you do the risk assessment, how you build out the contingency plan, or things of that nature. Okay. Well, it seems like we've covered a lot of ground in 30 minutes. I hope you found it useful. I hope you found it insightful. Through Robert and our team, we are available if you would like any additional support or guidance in this area. This is what we do, but I wish you great success. These are interesting times, but with adversity comes opportunity. And I hope you all find your vein in that direction. Thank you for your time. Again, my name is Jeff Rigsby, Chairman and CEO of Finance 500 and CB Resource. Looking forward to spending some time with you in the not too distant future. Best regards.